betting on two things, which are, is this market big enough to return enough for us to care about? And B, are these the right people to go and capture that market, right? So on the second part, it's like, do you have the right skill sets? You guys complementary? But on the first part, which is maybe even more important, it's, I think a lot of people think, oh, if a business is going to be a $1 billion business or a $500 million business, if that's the size of the market, that's great, right? The problem is, while that's great for them as a founder, it might not be great for investors. Investors need to make sure that every investment they make has the potential to return the entire fund that they've raised, because they know that 90+% of the investments they make are going to go to zero or some nominal amount that it gets sold for parts, right? So they need to make sure that every check they're writing has the potential to not just be, the company's not just worth 500 million or $1 billion or whatever, but that it can go even well beyond that and return 100 million plus to the fund. So I think that's something a lot of founders don't think about.
Hey, Michael, a question on that, a little deeper question on that. So let's say if a fund size is X, let's say if a fund size is 100 million, let's say, right? So what would be the average ticket size they would write for each of their portfolio startup?
Yeah, again, there's no specific answer. There's different strategies, right? So some investors, some VCs prefer to sort of do like a spray and pray approach, where they'll write small checks into a larger amount of startups, and they're basically betting on volume at that point. Like, hey, if we write checks into more startups, we'll have the same percentage, but more will do well, and so therefore the upside can potentially be higher if those wins are big wins, right? Yes. The other way is like what HF0, this accelerator that's like trying to compete with Y Combinator and actually, getting some traction and getting some great companies coming out of it in SF is doing, where they only let in, I think, 12 companies per quarter, right? And that's all they do. And they focus entirely on those startups, and they write bigger checks. They try to get in there and take a bigger position. It's really more about the ownership target, right? So like as a fund, you have a certain target percentage of a company that you want to own for it to make sense for you. Okay.
So for example, you gave me this example of, let's say, 12 companies from a fund, right? That is roughly 8 to 10% of the fund amount in each startup. Now, should each of these startups aim to become, let's say, 12 times of their current size, or the total fund size should be the revenue at the end of the journey? Like how to make sense of it?
I mean, you have to assume that all these companies want to IPO, right? You have to assume that all of them want to get to that stage. And so even if, when they get to the public markets, they're valued based on their revenue or their EBITDA or their free cash flow, whatever it might be, right? Even if that's how they're valued at that point, early stage VCs are thinking about it more in terms of like, what is the actual value of the company, and what is our stake going to be worth at that time? Right?
At that time, yeah.
Right. Yeah. So they're not really thinking beyond that too much. I don't think many people would probably say that straight up, but that's they're thinking more about how do we get to that liquidity event where it can bring money back into the fund and distribute back to our LPs.